Welcome to another episode of Investing in the Real World. My name is Anthony. This is where I share insights and information in the world of commercial real estate in hopes that you may be inspired and that the information will be helpful to you and your real estate investment goals. Today we're going to be talking about 1031 exchange. What is a 1031 exchange? Why does it matter? And what are the kind of rules in place that affect the 1031 exchange that investors use pretty often? Be sure to subscribe, like, and comment below, and let's get right into it. Okay, so what is a 1031 exchange? Well, first let's back up a little bit. If you sell something for a profit, you have to pay taxes on it, right? That's generally how it works. In the United States, you pay taxes when you earn money, when you spend money, when you make a profit, and sometimes even when you keep something for a while, right? You still pay property taxes on something you own, but you're still paying on it. But that's a whole nother topic, right? So you pay taxes on the profit. Real estate is a little bit different than other types of investments because there's a tax code called a 1031 exchange, what allows you to defer the capital gains, right? It doesn't wipe it out, but allows you to defer taxes on the profit. Capital gains is another word for profit, right? So the profit you made, if you sold a property, an investment property, you would have to pay taxes on it. Now, how much is it? Now, depending on your tax bracket, it could be quite a bit. It could be over 40%. So imagine this. You bought a rental. Even if it's a house, it doesn't have to be commercial real estate. You own a property, a rental property, an income property, and you bought it for $400,000. Market's great, value went up, it's worth $1 million. So your profit is generally about $600,000. Depending on your tax bracket, if that's 40%, that's $240,000. So $240,000 you have to pay taxes because you earned a profit. Because you did a good job, you have to pay taxes on it, right? So that's a big hit. So there's a tax code that if you follow the rules, allows you to defer your taxes and grow your portfolio. That's actually really common in the investment world. In fact, many of my clients, I've coordinated 1031 exchanges. Not too long ago, I helped one of my clients exchange a 4-unit building into an 8-unit building. So we sold this 4-unit building. During the period when we were listing the property, I was helping him look for properties. And when I found one that was ideal for him, he accepted the offer on his down leg. It's called a down leg, the one he sold. And then I helped coordinate the purchase of his up leg. It's called an up leg, the property that he purchased. Now, if he had more money, maybe if it was a bigger property, not a 4-unit, but maybe a 20-unit building, and he sold that, you can buy up to 3 properties. So he may be able to diversify and buy more than one property. In his case, we closed on the 8-unit building and he's happy. But for other investors, you can exchange and you could buy up to 3 properties. So sometimes people call, because it's exchange, they're saying, well, am I swapping my building? You're not swapping your building. What you're actually doing is selling your property, taking the proceeds, and rolling it on over into 1 or up to 3 properties, okay, deferring it. Why is it called a 1031 exchange? It's because the tax code. So the tax code, and you can see the tax code here, that's why it's called a 1031 exchange or a deferred exchange. Now, of course, with any transaction in real estate, there's an escrow company. With a 1031 exchange, there's also a new intermediary. They're called an accommodator. And so what their job is when you have to identify, because that's one of the rules is you have to identify 1 or up to 3 properties within 45 days of the close of your down leg. Your down leg, the property you sold, when you sell it, you have up to 45 days to identify in writing to the accommodator, okay? Now, you also have a deadline of you have to close on one of those properties or all 3 of them within 180 days. Okay, so you have to close on whatever you buy within 180 days. So 45 days to identify, 180 days to close. They clock both of those start when your property closes, so they're not like back to back. They're concurrently. So 45 days timeline to identify, and then 6 months in total to close. Another thing is you have to, whatever you buy has to be the same amount or larger to what you sold. You got to replace the value of the property that you sold. Okay, those are the rules. Why do investors do this? Well, aside from the fact that you defer your taxes on the profit, which allows your property and your portfolio to compound a lot faster, it's a little bit different and a better strategy, in my opinion, than refinancing a property to buy another one. Here's why. If you refinance a property to buy another property, you leave meat on the bone. You see, the bank is not going to give you a 100% loan for the equity you have in that property. But if you sell it, you're able to take all that equity and roll it over and expand your portfolio that way. So that is the nuts and bolts of how a 1031 exchange works, right? It's very prominent in the real estate world because it encourages investors to invest and keep investing. And the local area actually benefits as well, because every time a property transacts, they get a new property tax base, right? The property has a new assessment because it got sold, and so now they're paying higher taxes, which of course feed the local governments and everything like that. But that is the nuts and bolts of a 1031 exchange. It's very common in the investment world. Right now, there's a lot of talk of in this administration on if they're going to do away with it, if they're going to change it. My personal opinion is that it should stay because it encourages investment. I feel like we already pay a lot of taxes, and there's already an increase in property taxes. In California, you're capped out at a 2% increase of property taxes per year. But California is expensive. I know other states, they have different property tax bases. But if you want to encourage sales, which employs a lot of people, and you want to get new property tax base because a property gets sold, now it has a new property tax base to the new owner, you want sales to happen. If you get rid of the capital gains, then you're just eating into the profit, which is, for most people, most investors, it's part of their retirement, and a lot of times it supplements their income for private investors. So that's my personal opinion, but that is a 1031 exchange. Those are the rules about it and why it's important in the investment world. So I hope that was helpful. Be sure to subscribe, smash that like button, and comment below. If you want to reach out to my team and maybe you're looking to do a 1031 exchange yourself and expand your portfolio, you can reach us at investingintherealworld.com. Again, my name is Anthony, and our contact information is in the description. You take care and stay safe.